So I got on a plane in Newark, New Jersey, headed for Nashville, Tennessee. Oddly enough, Dan and Danny, I was in Nashville this time last year for a Georgetown University event. I flew down for something different. I actually had a speaking gig on Thursday of this week. Now, I mention that because I like to read on planes, as you know. Typically, I'll just sit there and stare forward. But this time, I actually brought a book. By the way, this is the On the Tape podcast. I am Guy Adami. That's Dan Nathan and Danny Moses. In just a few minutes, Gabriela Santos, the managing director and the global market strategist at JP Morgan Asset Management, will be joining us for an in-depth conversation about the market. But the book that I brought with me, Danny, and I think you might find this interesting, is For Whom the Bell Tolls. Ernest Hemingway, 1940, For Whom the Bell Tolls. And it really sort of struck me as odd. And there's a scene in the book, if there are such things, scenes in books, where the protagonist was, how do I say it, making love to a certain woman in the forest. And he asked her afterwards, did you feel the earth move when we were engaged in that act? And it made me think, of course, the great Carole King song, I Feel the Earth Move, which, by the way, I think she got from that. But what I'll tell you is the bells are tolling and the earth is moving under our feet. And why do I say that, Danny? Because AI is moving in one direction. And then in the other direction, you have consumer debt, you have retail stocks, you have banks that don't get off the mat, you have material stocks that are getting whacked, you have continued geopolitical risk with the United States and China, you have all these headwinds. The earth is moving under our feet, Danny, but nobody really seems to care.
I keep telling myself the stock market is not the economy, and the economy is not the stock market. And I'm looking for every excuse, people trust me, to turn bullish. I want to be bullish. You think it's fun to wake up in the morning and be bearish? It's not. No, it's not fun. I want to be willfully ignorant bullish and just go buy the tape on things that we knew were going to happen, actually that result in things that may make things worse in the future. So it is what it is. I mean, there are a lot of mixed messages coming out. I could find as many bullish data points, maybe, as bearish data points, but valuation, be damned. Let's just talk about this debt ceiling issue. The debt ceiling issue was resolved in a way that actually was very bullish. What do I mean? There is no cap on the debt ceiling until January 1st, 2025. Did you hear what I said, Guy? There is no cap. Borrow away. Let's just keep monetizing this crap all the way through, right? So we're going to go from 31.8 or where we are now to whatever it's going to be. Yes, they did cap some type of discretionary spending to a degree, but we just gave a blank check to the government, for better or for worse. We'll see how that lays out. But so that's one thing, right? So that, I guess, at the end of the day, that's bullish near term, right? Because it was resolved and now you can just spend on whatever you want to spend. But the cross currents, Guy, to which you're talking about, the other things that are out there, the consumer debt levels, things that are going to matter, that you can't just, well, unless the government decides to get rid of those too, don't just go away. That's happening. And yes, I get it. The mixed messages in the job market. I don't want to follow weekly job trends, right? I know we're getting a jobs number here again tomorrow. But how did we go in a 1 day period or 2 day period from a 70% chance of 25 bips higher to a 30% chance? We flip-flopped. And I'll keep saying, like I said last week, that is the number one driver in this market right now is Fed fund futures. That's it. Just overlay those changes to the S&P and that's what you get, because the people are looking for immediate reasons to be bullish or immediate gratification on the market.
Yeah, and I guess in the near term, when you think about this Fed meeting in a couple of weeks, the Fed fund futures were pricing, I think, at their highest 40% of a 25 basis point hike at the June meeting. That's come down now below.
No, it was above 60.
Was it really? Okay.
Yeah, it was.
All right. So now it's below 30 if we look at the CME Fed Watch tool there. Listen, I mean, never short a dull market, I guess. And that's really what we have had. If you think about it, over the last 2 months or so, we traded in this very tight range in the S&P 500. We've had the NASDAQ blow out. Semis are obviously a big part of that. Nvidia's move, over the last week and a half, gaining $300 billion in market cap is truly astounding. And you think about all the other names that it's dragged up. But to your point, guys, the Russell 2000 small caps get out of their own way. I know that, this is Thursday into the close. Energy stocks are bouncing a little bit with crude up 3.5%. But energy stinks, retail stinks, materials, metals, minings, all those stocks stink. Financials stink, both large cap and regionals, that sort of thing. But I guess without anything to kind of there's no boogeyman right now, I guess. The boogeyman was this debt ceiling, and we started talking about it early. I don't think any of the three of us thought there was really going to be a scenario where we defaulted, right, and sending global, financial markets and economies into disarray. But now it's really kind of hard to put your finger on it, especially at a time where people are totally disregarding any sorts of valuations relative to what headwinds to growth might be. And the last point, Danny just mentioned this May jobs report that's going to be out by the time you're probably listening to this. We still have unemployment at 3.4%, and even with all the consumer data that we're seeing, it still kind of belies, an economy that's doing okay.
The bogeyman is the incremental buyer. Who is the incremental buyer of the S&P up here? But I was saying before we came on air today, so when things feel really shitty and the market goes down and it's at the, it's getting punished and we're down to, let's say,
mid-October,
3,600, there's a point there where it feels inevitable that the market's going to absolutely crash, that everything's lined up. This is the exact opposite, right? This is the point where, to your point, I don't know what can happen to take the market down, to the point you just made, Dan, which probably means we're near the limit of where it's going to be to the upside, because it's not going to take a lot to get the market to kind of sell off. It feels like it's on fragile footing, right? It feels like it's a really thin piece of glass that we're on, but it is what it is. And I'll say it again, the chase begets the chase. These fund managers have to participate. Now they're getting embarrassed, right? They're going into this. I said this June's going to be crazy because the second quarter markups or whatever's going to happen here. This is going to be a race. So similar to January when we began the year, the longer that if June starts like this and keeps going, it may be a self-fulfilling prophecy. And there's nothing I can say differently, Guy.
Certainly feels that way. And again, we talk about passive investing all the time. Money flows are there regardless of headlines, regardless of what's going on with the underlying fundamentals. It doesn't seem to matter. Money is flowing into the market, and that continues to be the case. But one thing we mentioned earlier on Market Call this week was 7 stocks now comprise, and think about this for a second, 7 stocks comprise 29% of the S&P 500. That's a staggering number. Those same 7 stocks, I believe, are 60% or so of the NASDAQ. That is remarkable. And again, people say it doesn't matter. We've seen this before. Not to this magnitude. So the breadth of the market clearly is not there. Now, everything's getting dragged up on the euphoria around a certain number of things, not least of which is AI. But you're talking about valuations now for these companies that are absolutely stretched. And I don't want to harp on Nvidia because it's not necessarily fair. Dan talks about this all the time. They're a wonderful company. There's no denying that whatsoever. They've been managed extraordinarily well. A company now with $1 trillion market cap that maybe can do $50 billion in the out year. So you're still talking about a company that's trading 20 times revenues. And think about the growth that needs to continue to take place in order to grow into that valuation. I think it's staggering. And Dan, I think you mentioned this on OK Computer, and we talked about it as well. Sun Microsystems in 1999, 2000, we're talking about the same things. That CEO warned people of the inevitable, saying it was unsustainable. But here we are again, seemingly, Dan, making the same mistakes over and over again.
Yeah, the one point I would just make about Nvidia right now, and I've made this a couple times this week on Fast Money, OK Computer, and Market Call, anywhere anyone has a mic in front of my fat mouth here. Listen, the rally that has been sparked just in the last week, right, since Nvidia reported and guided higher, they guided higher by $4 billion on a $7 billion consensus. So they're expecting to do $11 billion in revenue. Think about what just happened. In the last week, okay, names associated with, Nvidia and the buying of these chips and the companies that are going to be deploying these chips into supercomputers and data centers, they're going to do all this stuff that these companies are not going to be able to really monetize anytime soon. It sparked a $500 billion rally in a week, a $4 billion revenue beat. So you ask me, how I feel about this, as a technology, as I feel about, the major platform companies in an arms race with each other, right? So they don't get left behind a little bit. I say, yeah, fine. This is like a normal tech cycle. We see this again and again and again, but we've never seen it to this sort of extent in such a short period of time. And so if you're buying into this now, and again, I might have said the same thing 3 weeks ago before this rally, it doesn't make a whole heck of a lot of sense. And I'll just say this, just to kind of put a bow on this. I mean, there is this concentration based on this one narrow premise that will broaden out fairly dramatically, but it's not going to broaden out from all-time highs in a stock like Nvidia that just ticked $1 trillion in market cap, or these other multi-trillion-dollar market cap companies that are spending a few $1 billion extra in a quarter. And that's, to me, what the risk is. So if you're buying it here, you tell me, let's say you're buying Nvidia at $400, okay, which was just $250 a month and a half ago. If you're buying it here and it goes back, let's say $50 or $100, are you going to sell it down there? No, you're probably going to average in. What are you going to do if it fills in the entire gap and continues to go lower? Okay, so my point is, people make fairly dramatic mistakes at these sorts of different bounds, right? They sell at the lows in October and they're buying at highs right here.
Danny, let me ask you a question. Yeah. We talked about the fact that I had watched The Big Short a few months ago, and I had a very heartfelt conversation with you on the podcast. I actually got a little emotional, but there's a scene in The Big Short that I think is eerily reminiscent of what's going on. The housing market, which you were betting against, was actually going the way you were betting. It was moving in the right direction for your positions, yet your positions were going the other way. Your positions were going against you. And I wonder the level of frustration you must have felt then. Does it sort of mirror the frustration that I know I'm feeling now, in terms of you could see the landscape, you can see what's going on, and things are actually working out the way you think they're working out, but the market, your positions are telling an entirely different story?
So Michael Burry's positions, he was in there early and he saw them go the wrong way. When we entered the credit default swap trade, the famous trade, it went in our direction immediately. However, our equity book prior to that certainly was frustrating, beginning in 2005, and really 6 when I joined them, and it was already clear in 2005. But in 2006, you remember the market made new highs in 2007. I mean, so it was evident to us, but people just were willfully ignorant into it. And eventually, there's one common denominator in that trade, which was home prices, right? You knew that the reversion to the mean had to happen, because if home prices stopped going up, the rating agencies did not have anything in their model for down home prices. I mean, think about that for a second. So that may have been inevitable. Now, again, Guy, you saw the movie. If the government had stepped in sooner and understood what was happening sooner in the markets, they could have buffeted that trade and no pun intended, although he did come to the rescue of Goldman, and stopped it from actually deteriorating to the degree. And again, I'm not going to compare 2008 to anything, but let me just say this. I'm looking here. When Dan was talking Nvidia, I just stopped listening. Not because I don't listen to what Dan says. I've had it with this. No, not because of you, Dan. Just in general. I'm looking at this R2D2 C3PO with the C3 AI thing, right?
Tom Siebel.
Yeah, Tom Siebel, famous Tom Siebel. Bubble Boy. So, looking at the stock that's down, it's traded up obviously into the quarter. But here's the remarkable thing about that. And I know they've rewritten the description of the company. Now it's just an artificial intelligence company, technology company. It must have been rewritten for years, although they've been in it, but it's mainly in the natural resources area. Anyway, 2 weeks ago, they came out, yes, we're AI, and they basically pre-announced the quarter, which they just announced, and they missed 2 weeks later. I'm trying to figure out how a quarter that was closed, right, and then announced, how is it possibly missed? I'm really confused on that for a second. So that's not an issue, except credibility-wise when you're dealing in the space, and that's why people are hiding. And let me just say this. I'm going to put my bullish hat on here for a second. We can talk all we want about market breadth.
It's a tiny hat.
That would be a big hat. Yeah. We can talk about market breadth. We can talk about whatever statistic that we want. At the end of the day, to 80% of retail that's trading out there right now, those 7 stocks are the stock market.
Yeah.
They don't give a shit. To them, the market's ripping. The bears are wrong. They're not taking a step back and looking at the underlying. And Guy, the point you just made on housing, I mentioned on a market call yesterday, okay, the FHA, the Federal Housing Administration, is now bailing borrowers out. They just passed they didn't pass it yet. It's a 30-day comment period where they're going to pay a portion of the mortgage payments, which are due. They're going to send them to the mortgage servicer, right? So they don't have to take the loan out. It's a long story, but a technical matter, they're actually providing 20, 30% in some cases of people's mortgage payments now that won't be able to afford it. That's in the lower end. That's not Fannie and Freddie, that's Ginnie Mae mostly. But to your point, Guy, like underneath the surface, things aren't getting any better. Credit card debt, we see it. So anyway.
So on 2 points that I just took away from that, credibility, okay, and valuation, there's a couple of things. So Guy, going back to the Scott McNealy quote, so he was the CEO of Sun Microsystems, okay, and this was a quote to Bloomberg in 2002. In 2002, late 2002, the NASDAQ was down, I think, 85% from its all-time high. Stocks like Sun were down like 90% or something like that. So this is McNeely's quote from 2002. 2 years ago, we were selling at 10 times revenues when we were at $64. At 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes that I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes that you pay no taxes on your dividends, which is kind of illegal. And then that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? Okay, so here's the point. Jensen Huang, okay, CEO of Nvidia, he's the fourth largest shareholder. He owns 86 million shares. Okay, those are worth, billions and billions of dollars. All the power to him. He's not. I mean, listen, is he making some hyperbolic comments about the new dawn of this AI era? Yeah, he is. I don't think he's like bubble boy. I don't think he's poster boy. Investors are willing to pay this, okay? And so when you think about the new guidance that they just gave, it was trading at 25 times this year's sales. Okay, you heard what McNeely had to say about his stock at 10 times sales back 21 years ago. I think that's just math, okay? So when people say to me, I was at a dinner last night, I'm going to not say who or whatever, I said at some point, in the not so distant future, Nvidia will get cut in half again. Everybody at the table, their jaws almost dropped and hit the table. Okay, that will happen. That's a certainty. Okay, and the higher it goes right now is the greater the certainty, in my opinion, because of this math. So history is certainly rhyming, if not repeating. I don't think a company like Nvidia is going to go down the way of Sun Microsystems, but all of the pieces are in place, and they're very, very similar than they were to the situation in the run up in the late 90s.
Meanwhile, I said, what was the incentive for Nvidia to give this guidance? Because they don't need to raise money. They filed a $10 billion shelf.
Yeah.
I'm not saying they're going to use it, but
Guy called it on Market Call Tuesday.
Do they need
Danny,
money?
what does he call that? A Friday night dirty?
That was a Friday night dirty. That's exactly.
But listen, they should be doing that. Why wouldn't they? Investors are the stock's up 5.5%.
No, I'm just saying that. But
people are
if that does
over
happen, then I question credibility. But who cares for today?
I mean, I believe their revenue guidance.
No. For the second quarter, I'm saying you said it yourself. Is that orders for the year? Is that orders, for take up guidance for the rest of the year? Yeah. I don't know what it is. Right. All I'm saying is they filed.
So here's the last one. Doug Cass brought this to my attention earlier in the week. Guy, I want to get your take on this. And this was in Barron's, and it was citing a Deutsche Bank calculation. He said from the beginning of 2023 through Thursday, this is last Thursday, the S&P was up 8% versus 1% decline for the equal weighted S&P, a difference of 9.3 percentage points. For all of 1999, the spread between the two measures was also 9.3 percentage points, which was exceeded only by 1998 when it was 16.3%. So again, we've seen this sort of concentration. You know what I mean? We've seen the spread between market cap weighted and equal weighted. I think it's just clear that this could go on much further than people expect. But at the end of the day, and I use this on one of our other pods. This is quoting, The Wire here. The game's the same. It just got a lot more fierce. And that's
only the names have changed. And that's clearly going on. And obviously, it didn't augur particularly well for the market going forward. And, you say it can last a lot longer. I agree with you there. I also say this. I think things happen a lot faster in today's world than they did, 23 or so years ago. So just keep that in the back of your mind. And, listen, technology, I get it. Everybody's all geeked up. I understand what's going on. We can talk about valuations till the blue in the face. People will tell you if you trade on valuation alone, you're destined to fail without question. I understand. But at a certain point, math matters. I said that last week, and I think McNeely's quotes are exactly right. And listen, I don't know if Nvidia is going to be cut in half, but I'll tell you something. They're in the real deep end of the pool now. And the move we saw higher was not short covering. That move was people piling in. So this is just now people adding to positions or new longs getting in. And we'll see how that pans itself out. Talk about a company, though, in terms of a crazy market, Danny. Broadcom or Avago, whatever they call themselves now, symbols AVGO. This was a $600 stock in the beginning of the month of May. I want to say May 7th or so. Traded north of $900. Now, you'll say, we're seeing this. It's a $300 billion company. And the move that we saw earlier this week when it traded north of $913-ish, only to close lower on the day, around 805, is not the sign of a healthy market. That's anecdotal. I get it. But this is not a small company. There's madness all around, yet people want to put the happy glasses on and say everything's just fine. And I would submit, along with the bond market volatility, which is back, along with 2s, 10s, which is inverting again to the tune of almost 80 basis points, you know what? There's a lot to be worried about out there.
Yeah, just to be clear. And so Broadcom reports Thursday after the close. So by the time you're listening to this, they will have reported. And, the implied move in the options market is about 12%. So to your point, Guy, about a $330 billion market cap company that is expected to move $30 billion in either direction on an earnings report. And given the volatility that we saw last week in Nvidia and some of the other names, I guess the difference here, and again, this is a cheaper stock on earnings. It's trading about 19 times expected earnings growth at 10% this year, 18 times expected earnings growth of 6% next year, but it still trades at about 9 times sales. Okay, so again, going back to McNeely's example from 20 years ago of a company at 10 times sales, I think people are piling into this because it's cheaper with some similar sorts of exposure, Danny.
Yeah, listen, it's Broadcom, AI chip deals, Apple, Meta, Google. They're in the right. They fall in the right category.
Yep.
And I look at Microsoft today. Yeah, it's a great company. It's traded in a $75 billion range today, which is bigger, I'm sure, than half the companies that are out there in the marketplace. The difference in 99, 2000 and today is that I remember again, we talked about it last week. There were a lot of companies that couldn't survive, that stocks would still go up, and we knew they weren't. These companies are going to survive. Most of the companies we just mentioned are going to be around. We're talking about valuation. Where does it settle in? When do things come back to earth? I am at the point right now that I am, when I just did push-ups, Dan, before the leaving.
I saw you.
I don't.
You only got to 7.
Well, I couldn't. I thought I was have a heart attack.
No, wait a second. Say that again.
No, I didn't. I could do 100. I think I could do 100. Anyway, my point is this. This is the moment. This is where I feel it. I feel it in my plums. I feel it in my plums. I feel it in my plums. I feel it in my plums.
Let the boy watch.
We're gonna have.
Let the boy watch.
We're gonna have. This is it. We are. I go. Oh yeah, Danny said that. This has to be, because I don't know what else to say here. I am. There's nothing to say that can either convince people to be careful, and there are many. There are a lot of smart people out there who aren't participating yet, who feel like, am I going to have to chase what? People, this will come back to earth, to the point that Dan and Guy are making. It just will. How long is it going to take? I don't know. And it's really frustrating when you work in an industry for so long that over a long period of time, all that matters is cards speak, as we say in poker. Fundamentals will matter. You go through these periods of time where they don't. And you're either going to grow into these prices or you're not. And the majority of these companies will not grow into these valuations. And how does it look and when does it happen? I don't know. But I'll play the long game. When I say long, I'm not buying. I'll play the long game here in terms of owning quality companies over a period of time. And I'm willing to miss all of this for the disaster at the craps table when you bet we have the pass line and then you bet the come bet 5 times and you are spread out on the 4, 5, 6, 8, 9, 10 with full odds behind it, and then the 7 comes and you lose it all. You know what I'm saying, Guy? Am I speaking your language?
I have been there 100%.
I've been playing the don't pass now for 4 months.
What's happening here, to use the poker parlance, Danny Moses is sitting with pocket queens. The cat on the other side of the table has 2-7 offsuit, and the flop comes out 2-7.
100%. And by the way, and I'm all in, because who could possibly have stayed in with 2-7 offsuit right in my ear? Anyway, yes, continue.
And that's what's going on in the market here. And again, not to cherry pick, because that's not what we're doing.
Yeah.
But you look at what's going on across the retail landscape, and we say this all the time. 73% of this economy in the United States is driven by people basically buying shit or doing shit. That's just the fact. And you look at what Dollar General said. Dollar Gen went down 16% on Thursday. Once $32, $33 stock move, the lowest level we've seen in multiple years. But it's not just Dollar General, Dollar Tree. Look at what Target said. Now, people are going to say, well, Target is getting beaten up on this whole woke thing. That's horseshit. Target was going down a lot longer than that. It was going down long before that came out. So they're retailers across the spectrum. You say in the high end, you know what? The high end's starting to feel it as well. So across a swath of retail right now, we're seeing some weakness. Dan, what do they call it when we put stuff in the show notes?
We say we're going to put it in the show notes.
Oh,
yeah.
Kindling?
Well, we should put the Dollar Gen comments in the show notes because they are seeing something that the market does not want to or is unable of seeing.
You know, it's funny. And Danny has made this point on many occasions that, obviously, doing your bottoms up work and looking at companies sometimes like, away from your kind of macro views, your top down is really important. And sometimes, though, it's really hard to kind of put things together and figure it all out because everything you just said about Dollar Gen and Target and is interesting. But then I look at like what you just kind of ended that commentary, Guy, about some of the higher end stuff. Well, look at Nike is sold off 20% in just the last month and a half. Look at Starbucks is down 15% in the last month. Look at Disney that's down 15% in the last month. And all three of those stocks used to trade at a premium to their peers. They used to trade at a premium to a market multiple, right? And you were paying for high quality and really durable discretionary spending, right? And so what do you make of that when you see those three names? Like you could have put together a nice little ETF pre-pandemic, you know what I mean, with those three stocks. It would have been like take it to the bank. That's a blue chip sort of thing. And they act like dog shit. And so it's just kind of funny when you put it all together. I mean, today I'm looking at my FactSet screen. It is a rip-roaring day and it is a broad rally. And if you are bullish, you really want to pray for breath. You almost want those big 7 or big 8 to slow down their ascent, and you want energy to join the party. You want big banks to get back on their horse because some of those big money centers act horribly. I'd say like today, Goldman Sachs talking about trading revenue is going to be down 25% in whatever period they're looking at, and they're considering further job cuts. That stock's down, again, next week at some point, I'm sure we'll have the KRE down 5% or something like that. There's no quick fixes, I guess, for the stuff that's coming off. And really what we're talking about here is that this kind of, whether the Fed pauses, whether they I don't know, whether they say they're done, one and done, or this and that, whatever, it's still this lag effect of 500 basis points, right, working its way into the economy. It still really hasn't been shown, not in the stock market. Again, Danny, this is going back to dissecting the difference between the market and the economy. There are parts of the market that act like we are in a recession, but I guess when you look at the S&P up 10.5% and you look at the NASDAQ 100 up 33%, it really feels like we are in a rip-roaring economy. And really the only thing that's working in the economy right now are low unemployment, right? And housing. I mean, like when you think about it, because everything else kind of feels like crap.
Yeah, VIX is under 16, by the way, just so we're on the same page. So that's normally the point where, Guy, I think you would agree, that's the point where you got to start to be very careful. In terms of shorting volatility at these levels, there's really not much more room for it to go down. But yeah, the real economy stuff that you can't really meme and you can't AI it and you can't do, that are actual tangible equity earnings numbers that can't be dreamt, that can't be changed, right? That can't be whatever, aren't going to participate in something like this because you want to be, again, willfully ignorant, or you want to believe in a dream. You can dream these things.
That's exactly what happened in late 1999. I mean, that's kind of the point, is that like all those groups that we just talked about, they started kind of rolling over and people still believed the dream, but because of the concentration in the major indices, that's why we continued to see what felt like a bullish market despite the warning signs that were flashing in the economy.
Jim Bianco said it a couple weeks ago on the tape. It was a great episode if you haven't listened to it. Just about how the economy changed permanently. When I say permanently, probably for a generation because of COVID. People changed the way they live, they changed where they work, they changed their habits, everything changed, right? So part of this can be just attributed to kind of what's the new, right? And I'll tell you this, if you're not performing as a company in this environment right now, and there's a reason that a lot of these stocks are being left for dead, you tell me a bullish case for a company that is already not being able to produce numbers, Dan, and or is having issues in retail, because what can they change right now in the face of consumer, which is facing headwinds? I don't care what anybody says. Yes, inflation may be coming down, but rates are staying stubbornly high. And even when the 10-year yields come in and so forth, the borrowing rates are still staying high because the spreads are still staying wide. And so it's the haves and the have-nots, and no one cares about the have-nots right now. They're just not going to own them. They're just going to shift to these other names, and they're willing to overpay for growth, what they believe is growth, and or FOMO, and leave these, quote, value stocks behind. And that's...
It gets dangerous now because I think the voices that are trying to warn or have concern get drowned out by the broader market. With each passing day, we're in June now, it gets more and more difficult. Dan, you mention this all the time. People will start to chase, and people just don't want to hear it at a certain point. That's, though, I think, when you have to get the peak of being cautious. I mean, that's when all the warning signs should be going off, when, the most ardent bears, or whatever you want to call people that have been warning, start to sort of fall into the ether, and you no longer hear the voices, and it's just the continued parade of people saying how great everything is. That, to me, is when things get a little bit scary. And I'm telling you, valuations, this entire move, in my opinion, it's not on earnings growth. It's certainly not on revenue growth. I guarantee for most of these companies, it's not on margins. It's all on multiple expansion. And how long can that last? Dan said it earlier. It can last a lot longer than you think. But we're pushing the envelope here in terms of multiples. And I get worried that people are going down the same path we've been down a number of times, where they throw caution to the wind and they get themselves involved in things they probably shouldn't be in.
It's interesting. We had this conversation, Guy, with Liz Young from SoFi earlier today, and I think it's really important. We were quoting John Butter's work. He's a senior earnings insight analyst over there at FactSet, and he tracks, all of the guidance that is given by S&P 500 companies. In his report that dropped today in the Earnings Insight blog, analysts are cutting earnings estimates for S&P 500 companies for Q2 2023 by 2% aggregate during the first 2 months of the quarter. This decline is smaller than the 5-year average, the 10-year average, the 15-year average, and the 20-year average for this period. What's interesting is the 3 prior months, these cuts were about 5% or so, okay? So again, that's as the market was bottoming, right? It bottomed in October and it kept on going. So estimate cuts for each quarter were coming down for the first 2 months, 5%. Now they're only down 2%. So I guess the question that I have, Danny, is when you think about that, we've had this huge 20% rally off the lows in the S&P 500, right? As estimate cuts were coming at 5%. Companies were beating those lowered estimates, right? The stock market has reacted. Now the level of the cuts is getting really small. At some point, if there is a downward revisions period again, right? That could be the thing that causes investors to start thinking about where the S&P is trading at about 18 times, which is basically in line with the 5-year average and a little above the 10-year average, despite the fact that the Fed funds is 5%. And during that I know I just broke your brain.
Hold on, let me just say,
yeah.
What does FactSet say the 2024 S&P earnings are? 246?
Yeah, so we're looking up 9% or something like that. That's
just tell me, is that the number? Because I'll tell you what bulls do.
Yeah, what do they do?
Once the second quarter gets reported, and no matter what it is, they'll just look ahead to 2024, and we're trading it. By the way, we're trading it 17 times right now.
Yeah,
2024, which
so we're
is
in line
really
with the 10-year average, basically.
Right. So give me again with this whole thing. Who cares though? Because in 2024. The Fed's going to be cutting rates, and we're going to be, kick back. So I could argue on one side or the other. The bottom line is, I'll just say this again: fundamentals. Hands are getting forced. Fundamentals be damned. You got to stay in business at this point, and that's the level that I feel like some of these funds, and I say hedge funds as well, right? They went through this period of time they thought was over, of massively underperforming the passive markets, massively underperforming, right? Just to hold your nose, cover your eyes, and buy something. Stock picking came back. It did. It came back for about 5 quarters. It's gone. Now, you could argue the stock picking's alive and well because you're buying, but no smart money manager, when I say smart, and one that's really buying stuff in terms of valuation, running models, can justify the majority of these moves. They can't.
Well, here's the thing. They are buying and they are chasing, and, like S&P futures, like open interest and all this stuff, and, and puts, they're at really, really high levels, okay? So on the puts. And so that's, I think, giving some people this false confidence that hedge funds are really short. No, they're long these things. They're YOLOing all these calls and all these big names. We've seen this before, okay? And they're just hedged up with S&P futures. When you think about it, because the concentrations make sense. If you're long and you're generating all of this alpha in these single names, right? But then you're either short futures or long puts in the major indices, that works. It gives you the confidence to stay long.
The guy knows, and you know this too, these are the tap on the shoulder days. These are the tap on the shoulders on the levered funds, right? When I say the levered funds, you got the millenniums out there, so with the Baliazis and so forth that run these pods of different sector pods, and they levered 2, 3, 4
They
times.
lever, but they don't
Hold
have
on.
big nets though, Danny. Like net
No, I
exposure.
understand,
Yeah.
but they don't. But this is when they start to underperform and they get the tap to bring things down. And so bringing things down for the most part, right? You could be short some of these names, Dan, is my point, that are driving these higher, and it feeds on itself. And I said the other day, I'm like, AI has been alive and well in HFT, high-frequency trading world now for 15, 20 years in terms of the quants that know exactly what's happening, what's being bought, what's being sold, getting ahead of it, and the trend followers and the people that are picking up on it, right? And I think it's helping feed this fire. And to be fair, it feeds its way on the way down too. So it's not just about being on the way up.
Yeah, I just want to say one other thing too. And so if you're listening to this, you probably notice a different tone here. This is not kind of a throw in the towel or anything like that. I mean, for me, and I think I've been very clear on this, and I talk basically almost every day on this sort of stuff. So if you're listening to us now, you probably listen to Guy and me in Market Call, or the other on the tape that we do, or the OK Computer or Fast Money or whatever. I mean, listen, I've been very honest. I mean, my performance trading in the last 4 months has been about as bad as it's ever been. But I can tell you this, and I mean this sincerely. I mean, I feel about as good of our commentary at any time, because if all you want to do is turn on the folks with the pom-poms all day long, I mean, Guy, and I know you kind of have some similar feelings about this. When I think about making a story, a bull case or a bear case on a name, I want to know what the other side of it is, right? And so I think on a lot of levels, you could say, all right, well, that Nathan guy, he's a great contrarian indicator. That's fine. I mean, I'm right more than I'm wrong, and that's the main crux of this game here. But I think my analysis is usually fairly spot on, and sometimes just kind of getting the market timing and the sizing and all that sort of stuff right. That's the hard part here.
Market makes us has the ability to humble us all, and it's done it for me I'm going on, I think, 36 years or so in this business, and it's remarkable. I say it all the time, and I think both of you would acknowledge this. There are times when you could tell me 2 or 3 days prior all the news that's going to come out and say, this is what's going to happen. We want you to trade on the back of that, and I will do things that'll be completely opposite of what's going to happen. So even if you know outcomes, sometimes you're going to be wrong in the market, and I think that's where I find myself right now. But Dan, you're a pretty voracious listener of podcasts. Is that true?
True.
When do you think podcast? I have no idea the answer to this, by the way. I'm sure you know. When do you think podcasting started?
Probably 2009, 2008, 2009.
The aughts. That's what they call those things, right? The aughts.
Yeah.
I can almost categorically guarantee you that On the Tape podcast is the first podcast in history to somehow weave Ernest Hemingway, For Whom the Bell Tolls, into Carol King's I Feel the Earth Move, into a market diatribe. There's nobody else that's ever done that before. Just my opinion. Dan.
All right, fair enough. Yeah, and actually, I think some of the first podcasts were like over 20 years ago, believe it or not. I think I read something recently about that. All right, so we had a great conversation here, boys. Let's kind of lick our wounds over the weekend a little bit. Let's try to find some ways to be constructive going forward here. But we're going to keep doing what we do, calling it the way we see it. Stick around. Guy was not present for this conversation. He was en route to Nashville. But Danny and I had a great conversation with Gabriela Santos of JP Morgan Asset Management.